watching Big Brain Energy.
Kia ora e hoa mā. Today we're going to cover everything you need to know for the elasticity topic within NCEA AS91401 3.3, Demonstrate Understanding of Microeconomic Concepts. This is an internal with 5 credits. It's usually assessed as 3 in-class tests on each of the core topics, elasticity being one of them. But your teacher might be assessing it in a slightly different way. Sometimes it might be more like an assignment or even like an essay. In this video, we will cover all of the things they could test you on for this part of the internal. We're going to go over in clear and simple terms all the things you need to know. None of the waffle, none of the jargon, just the things you need to know. We cover everything up to an excellence level. If you get a good grasp on what we covered today, there's no reason why you can't get excellence. The topics in this video that we cover are Introduction to Elasticity, Price Elasticity of Demand, Cross-Price Elasticity of Demand, Income Elasticity of Demand, and Incidence of Tax. In the descriptions, we have all the timestamps, so you can flick through any of the sections you need to rewatch. You'll also find in the description the link to our website, where we have more resources such as practice tests and flashcards. Feel free to leave comments down below with questions you would like us to clarify about the content. And check out our channel for more New Zealand-based economics videos. Alright, let's dive into the first topic.
Have you ever noticed how people respond differently to different items? Say the price of petrol increases by 10%. People will buy less of it, but not much less. Whereas when the prices at a restaurant increases by 10%, way more people will stop eating out there. Why are the responses to a price increase so different? Well, because different items have different, what we call elasticities, and that's what we're going to dive into today. Elasticity of demand measures the responsiveness of consumers' demand for a product when its price changes. Basically, if the price of something increases, do people buy way less of it or just a little less? For AS 3.3, this is a definition that you'll need to memorize. Elasticity exists on a spectrum. This means that something isn't strictly inelastic or elastic. Rather, everything's a mixture of both, but leans towards one way or the other. If it is exactly in the middle, it is what we call unit elastic. Down one end of the spectrum are goods with inelastic demand. Inelastic demand means that a change in price will result in a proportionately smaller change in quantity demanded. So if the price of it increases, people will buy less, but not heaps less. This is a definition you'll need to memorize for the test. You can see on this graph that the change in price is a lot bigger than the change in quantity. Hence the definition that for items with inelastic demand, a change in price will result in a proportionally smaller change in quantity demanded. An inelastic demand curve is quite steep looking when you draw it. Things that typically have inelastic demand are items for which, when the price increases, you'll buy less, but not heaps less. For example, necessities, which are things that you have to buy, or items with not many substitutes, which are other options you could buy which fulfills the same need. Perishables, which are things which get consumed quickly, or addictive substances. Let's look at some examples of each. Necessities are things which you have to buy, even when it's expensive. For example, electricity, rent, or toilet paper. Even if toilet paper becomes really expensive, you still have to buy it, right? For items with not many substitutes, you really have no other option but to buy it if you want that thing. For example, petrol, or school textbooks. If you have a regular car, petrol is the only thing you can fill it up with. You can't just, use cooking oil and hope for the best. Or if your teacher tells you to get a specific textbook, you have to buy that specific one. So even when the price increases, you don't have much of a choice but to buy it. Perishables means that you have to buy it within a short time frame. So you can't just wait out a price spike. For example, milk, or eggs, or an Uber at 2 a.m, or concert tickets. Like, if you want to go see Harry Styles, you're still going to buy the tickets even if the price increases a bit, because otherwise you'll miss out on your time frame to buy it. Same with an Uber at 2 a.m. You can't exactly just chill out in town for a few days while you wait for the price of Ubers to get cheaper. Finally, if something's addictive, then you're going to keep buying it regardless of the price. If you're addicted to alcohol, even when it's expensive, you'll still buy it. Cigarettes are another classic example here. They're pretty expensive, yet if you're a smoker, you still buy them. Same with caffeine. The price of coffees has increased quite a bit recently, and we might buy a little less, but if you're low-key dependent on your morning brew, you're still going to buy one. Let's look now at the other side of the spectrum. Things with elastic demand. Elastic demand means that a change in price will result in a proportionately larger change in quantity demanded. So when the price increases, most people will just choose to buy less of it. An increase in price results in quite a big decrease in quantity demanded. You can see here that the change in quantity is proportionately larger than the change in price. Things with elastic demand have a flatter demand curve. What sorts of things might have elastic demand? These are things that, when the price increases, you'll buy heaps less of it. For example, luxury items, things that you buy as a treat, or items with many substitutes available, or durable items, which are things that last a long time. Let's look at examples of each. For luxury items, you don't have to buy them, so when it's more expensive, you just won't buy as much. For example, movie tickets, or eating out at restaurants, or vacations. If the price of a movie ticket randomly increased to like $40, you'd just not go to the movies, right? Or at least not go as much. For items with many substitutes, if there's something else that does the job and it's cheaper, you'll simply just buy that one. For example, fast food. If the price of Macca's increased a lot, you'd just go to BK or KFC instead. Or branded sneakers. If the price of Nike sneakers soared, most people would just simply buy a different brand. Same with fizzy drinks. If the price of a Coke can increased, you just opt for Pepsi or Fanta or something. For durable items, things which last ages, you're usually not pressed by a time limit to buy them, so you can just wait until they go on sale. Things like furniture or cars or electronics like laptops. If you want to buy a new couch, for example, most people don't just go to the couch shop and buy a new couch that day, right? They'd probably wait till Boxing Day sales or when they can afford them. So if the price of couches soared randomly, we can just wait out the price spike. And that's basically all you need to know for this first section of elasticity of demand. Here's a summary of what you'll need to memorize for AS 3.3. Elasticity of demand measures the responsiveness of consumers' demand for a product when its price changes. Inelastic demand means that a change in price will result in a proportionately smaller change in quantity demanded. For example, rent, petrol, movie tickets, or cigarettes. Inelastic demand curves are steep. Elastic demand means that a change in price will result in a proportionately larger change in quantity demanded. For example, movie tickets, Nike sneakers, or couches. Elastic demand curves are flatter. Let's put this new understanding into practice. Which of these items do you think is most elastic? Petrol, rent, or movie tickets? The answer is movie tickets. When the price increases for movie tickets, people would just choose to go to the movies less. Which of these items do you think is most inelastic? Laptops, school textbooks, or vacations? The answer is school textbooks. When the price increases for a textbook, you kind of have no other option but to buy it still. Which of these items do you think is most elastic? Taylor Swift Eras Tour tickets, bubble tea, or bus tickets? The answer is bubble tea. When the price of bubble tea increases, you just choose to get something else instead. Which of these items do you think is most inelastic? Milk, Netflix subscriptions, or St. Pierre's chicken on rice? The answer is milk. When the price of milk increases, you can't just wait out the price spike, you have to buy it if you want milk. Arguably though, St. Pierre's chicken on rice is a necessity. Let's take this back to the start. When the price of petrol increases by 10%, people don't buy much less petrol. When the prices at a restaurant increases by 10%, they'll get way less customers. Why are the responses to a price increase so different? Well, as you now know, different items have different elasticities. Petrol is likely more inelastic, and restaurants are likely more elastic.
So that was all you need to know about the concept of elasticity. We're now going to take a look at how to calculate price elasticity of demand.
We know that petrol has inelastic demand, and so does rent. But is one more inelastic than the other? How can we know? Well, we can find this out by calculating price elasticity of demand. By the end of this video, you'll be an expert in how exactly to do that. Price elasticity of demand, or PED, measures the responsiveness of quantity demanded to a change in price. It tells us if the price of something changes, how much will the quantity decrease by? To figure this out, we simply use a formula. There are two main formulae, but check in with your teacher to make sure you use the one they want you to use. The first method is called the percentage change method. The formula is PED equals the percentage change in quantity over or divided by the percentage change in price. For example, the price of Duolingo Plus increases by 10%. This results in consumers decreasing their demand by 20%. What is the elasticity of Duolingo Plus? Well, we simply just plug the values into the formula. PED equals the percentage change in quantity, which is 20, over the percentage change in price, which is 10. 20 over 10 equals 2, so Duolingo Plus has a price elasticity of 2. The only thing to be aware of here is make sure you don't put the percentage symbols in your calculator. It's not 20% over 10%, it's just 20 over 10. Great, so that's all good and well, but what on earth does an elasticity of 2 actually mean? Well, once you've figured out the number, if the answer is between 0 and 1, it means it has inelastic demand. If the answer is exactly 1, this means it has unitary demand. Or if the answer is more than 1, this means it has elastic demand. Again, if it's between 0 and 1, it has inelastic demand. If the answer is exactly 1, it has unitary demand. Or if the answer is more than 1, it has elastic demand. One important trick here is that you need to ignore any negative signs in your calculations. Basically, the answer is always going to be negative, so we simply just ignore any negative signs, looking at just the absolute value. Looking back at our question, we can see that Duolingo Plus's elasticity of 2 is greater than 1, meaning that Duolingo Plus has elastic demand. That's the percentage change method. The other most common way to calculate price elasticity is using what we call the midpoint method. Now, fair warning, this formula looks pretty scary. Don't worry though, we'll do a few examples at the end of this video to help it stick in your brain. The midpoint method says that price elasticity of demand equals Q2 minus Q1, which means the new quantity minus the old quantity, over Q1 plus Q2 divided by 2. This bottom half of the fraction is just how we calculate the average quantity. The brackets around it means that you solve that bottom half of the fraction first. And then, this is where it gets scary, we take all of that and we divide it by the same thing but for price. So we go the new price, P2, minus the old price, P1, over the average price, which is P1 plus P2 divided by 2. And that's it. I promise there's no more fractions on top of fractions on top of fractions. Right, let's look at an example. The price of Duolingo Plus increases by $20 to $25. This results in Plus users decreasing from 1,000 users to 700. What is the elasticity of Duolingo Plus? Alright, the new quantity, Q2, is 700, minus the old quantity, Q1, which is 1,000. Put that over Q1, 1,000, plus Q2, 700, divided by 2. Now we divide all this by the same thing for the price change. The new price, P2, is 25, minus the old price, P1, is 20, divided by P1, 20, plus P2, 25, over 2. There we go, no more numbers. The top half of the fraction simplifies to negative 0.35, and the bottom half simplifies to 0.22. And 0.35 divided by 0.22 is 1.59. Remember that we ignore the negatives. Going back to our rules for how we interpret the answer, 1.59 is greater than 1, so Duolingo Plus has elastic demand. Whew, that was a lot of numbers, but don't worry, that's all the tricky information. To interpret the answer to the calculation in words, you follow this wording. A 1% increase in the price of whatever you're talking about, in this case Duolingo Plus, results in a 1.59%, or whatever number you calculate, decrease in the quantity demanded. Alright, that's everything you need to know for this topic. Here's a summary. We have two common methods here to calculate price elasticity of demand. The percentage change method and the midpoint method. If your test is closed book, you will need to memorize these two formulae. I recommend using flashcards to help. The answer that you get when you use these calculations tells you how elastic the item is. If the answer is between 0 and 1, it has inelastic demand. If the answer is exactly 1, it has unitary demand. Or if the answer is more than 1, it has elastic demand. Remember that you just ignore any negative signs when doing your calculations. To interpret the answer, we say that a 1% increase in the price of whatever you're talking about results in a X%, whatever the answer to the calculation is, decrease in quantity demanded. All right, let's put this all into practice with some exercises. Feel free to pause the video if you need more time to think. Which of these elasticities would we classify as inelastic? 2.3, 0.21, or negative 1.6? The answer is 0.21 because it is between 0 and 1. Which of these elasticities would we classify as elastic? Negative 6.5, 0.13, or negative 0.7? The answer is negative 6.5 because it's more than 1, ignoring the negative. Calculate the elasticity of demand for rubber duckies if the quantity increases by 30% in response to a 10% decrease in price. Determine if it has elastic or inelastic demand. Here the question gives us percentages, so we use the percentage change method, where the price elasticity of demand equals a percentage change in quantity over the percentage change in price. In this case, the percentage change in quantity is 30, and the percentage change in price is 10. 30 divided by 10 is 3, which is greater than 1, so rubber duckies have elastic demand. Calculate the elasticity of demand for Ubers in Wellington if the quantity demanded increases by 15% in response to a 20% decrease in price. Determine if it has elastic or inelastic demand. The percentage change in quantity is 15. The percentage change in price is 20. So, price elasticity of demand is 15 divided by 20, which equals 0.75. This is between 0 and 1, so Ubers in Wellington have inelastic demand. Calculate the elasticity of demand for energy drinks if the quantity demanded decreases from 1,000 units to 800 units in response to a price increase from $2 to $2.50. Determine if it has elastic or inelastic demand. Now we are given whole numbers, so we have to use the midpoint method. The new quantity minus the old quantity is 800 minus 1,000 over Q1 plus Q2, which is 1,000 plus 800, divided by 2. All of this over the new price minus the old price, which is 250 minus 2, over P1 plus P2, which is 2 plus 250, divided by 2. The top half simplifies to negative 0.22. The bottom half simplifies to 0.22. 0.22 over 0.22 equals 1. So the demand for energy drinks is unitary, or unit elastic. Calculate the elasticity of demand for Hail Mary movie tickets if the quantity demanded increases from 300 tickets to 400 tickets in response to a price decrease from $50 to $40. Determine if it has elastic or inelastic demand. Q2 minus Q1 is 400 minus 300. Q1 plus Q2 is 300 plus 400 over 2. P2 minus P1 is 40 minus 50 over 50 plus 40 over 2. The top half simplifies to 0.29, and the bottom half simplifies to negative 0.22. 0.29 divided by 0.22 is 1.32. So, because this is greater than 1, the demand for Hail Mary movie tickets is elastic.
So that was all you need to know about calculating price elasticity of demand. We're now going to look at how to calculate cross-price elasticity of demand.
There are some things which you never buy together, like petrol and diesel, and there are some things which you often buy together, like shampoo and conditioner. We call these substitutes and complements. How exactly we classify these items is what we're diving into today, using cross-price elasticity. Cross-price elasticity of demand, or XED for short, measures the responsiveness of quantity demanded of one good to a change in price of another good. This is a definition you'll need to memorize for the test. Basically, it says if the price of something increases, How does this affect how much people will buy of something else? Like, if the price of Coke increased, people would want to buy more Pepsi. Exactly how much more would they want, and why? We classify pairs of items as either substitutes or complements. Substitutes are goods that are typically used instead of each other. For example, Coke and Pepsi, or butter and margarine, or Macca's and BK, canola oil and sunflower oil, or Spotify and Apple Music. For each of these pairs, you usually just buy one or the other, and not both. You probably don't have both Spotify and Apple Music, right? They serve the same purpose, so you just need one. They're substitutes. Though I'm willing to die on the hill that Apple Music is superior. Complements are goods that are typically brought together. For example, movie tickets and popcorn, or bread and butter, left shoes and right shoes, or concert tickets and merch, or burgers and fries. When you buy one of these things, you'll often buy the other two. If you get a burger from Macca's, you'll probably buy some fries too, right? They're complements. To determine whether something is a substitute or a complement, we can use an equation. Depending on what the answer to that equation is, tells us how exactly to classify it. If the cross-price elasticity is positive, then the goods are substitutes. If the cross-price elasticity is negative, then the goods are complements. This exists on a spectrum, meaning things aren't strictly one or the other. Certain things can be more strongly one way or the other. Something like left shoes and right shoes, for example, are probably stronger complements than bread and butter, unless for some reason you have one leg. To calculate cross-price elasticity, there are two main methods. You'll notice that they're quite similar to calculating price elasticity. The first method is the percentage change method. The formula is cross-price elasticity equals the percentage change in the quantity of one of the goods over the percentage change in the price of the other good. So we're looking at the change in quantity of one thing in terms of the change in price of another thing. Let's do an example. Suppose, when the price of a movie ticket rises by 12%, the quantity demanded for popcorn decreases by 10%. Calculate the cross-elasticity of demand between movie tickets and popcorn and determine if they are a substitute or complementary goods. The percentage change in quantity of popcorn is negative 10. It's decreasing by 10%. The percentage change in price of movie tickets is positive 12. It's increasing by 12%. Negative 10 over 12 equals negative 0.83. Let's take a look again at our rules. If XED is positive, then the goods are substitutes, or if XED is negative, then the goods are complements. In this case, XED is negative, so popcorn and movie tickets are complementary goods, which makes sense because movie tickets and popcorn is something that you would typically buy at the same time. The other method of calculating cross-price elasticity is called the midpoint method. Fair warning, the formula looks pretty scary. Cross-price elasticity equals the new quantity of one of the goods, QA2, minus the old quantity of that good, QA1. So like if the amount of popcorn sold decreased from 100 to 70, it would be 70 minus 100, over the old quantity plus the new quantity divided by 2. This bottom half of the fraction is just calculating the average quantity. And then we get a little scary here. We take all of this and we put it over the same thing for price. So the new price of the other item, PB2, minus the original price of that item, PB1. So the new price of the other item, PB2, minus the original price of that item, PB1, over the average price. So the original price plus the new price over 2. In this formula, Q stands for quantity, P stands for price, A stands for one of the items, so everything with an A refers to the same item, and B stands for the other item you're looking at. 1 stands for the old version, and 2 stands for the new version. The brackets mean that you simplify those mini fractions first. Okay, crikey, let's do an example. Suppose that when the price of movie tickets rises from $20 to $25, the quantity demanded for popcorn decreases from 100 buckets to 70 buckets. Calculate the cross-elasticity of demand between movie tickets and popcorn and determine if they are substitute or complementary goods. The cross-price elasticity equals the new quantity of popcorn minus the old quantity, so 70 minus 100, over the old quantity plus the new quantity, 100 plus 70, over 2. All of this over the new price of movie tickets minus the old price, so 25 minus 20, over the old price plus the new price, so 20 plus 25, over 2. And that's it. Whew. Let's solve this now. The top half of the fraction works out to be negative 0.35, and the bottom half of the fraction is 0.22. Negative 0.35 over 0.22 equals negative 1.59. And there's our answer. The cross-price elasticity between movie tickets and popcorn is negative 1.59. Let's interpret this. Our rule said that if XED is positive, then the goods are substitutes. Or if XED is negative, then the goods are complements. In this case, it's negative. So popcorn and movie tickets are complements, which makes sense because you often buy them at the same time. So that's the two methods of calculating cross-price elasticity. The last thing you need to know for this topic is about how to illustrate these effects on a graph. There are only two scenarios you'll be asked about. Firstly, that the items are complements, for example, movie tickets and popcorn, and the price of one of them increases, say the price of movie tickets increases. When the price of movie tickets increases, the demand for popcorn decreases. Basically, if movies become more expensive, you wouldn't go there as much, so you don't need as much popcorn. We show this on a graph by first drawing a graph for movie tickets, then a graph for popcorn. We use a typical market graph which has price on the y-axis and quantity on the x-axis, and a downward sloping demand curve. It doesn't matter if you draw this demand curve straight like this one or as a curve. Then you show the price of movie tickets increasing from P1 and Q1 to P2 and Q2. Next, we'll draw the graph for popcorn, showing the demand for popcorn decreasing. This means that we draw a new demand curve, D2, to the left of the original demand curve. So you can see that the price for movie tickets is increasing and the demand for popcorn is decreasing. This is the first scenario you may have to draw. The other scenario is when there is a price increase for a substitute good. When the price of, for example, Spotify increases, the demand for Apple Music increases. Basically, if Spotify got more expensive, a lot of people would just turn to the dark side and get Apple Music. So, just like before, we draw a graph showing the price of Spotify increasing. This graph looks exactly the same as the one we drew for movie tickets, with P1 and Q1 moving to P2 and Q2. Then, we draw a graph to show the demand for Apple Music increasing by drawing a new demand curve, D2, to the right of the original demand curve. Alright, so that's all the graphs you'll need to know. The price of one thing increases, and that either decreases or increases demand for the other thing, depending on if it's a complement or a substitute. Alright, so I know that's a lot of new information, but that's everything you need to know for this topic. Here's a full summary. Substitutes are goods that are used instead of each other. Complements are goods that are brought together. If XED is positive, then the goods are substitutes. If XED is negative, then the goods are complements. There are two main ways of calculating cross-price elasticity, the percentage change method and the midpoint method. We can illustrate the effect of a price increase on some graphs. The top two graphs shows the situation for complements, and the bottom two graphs shows the situation for substitutes. So then, let's try and help this new material stick in your lovely brain with some practice questions. Feel free to pause the video to answer the questions if you need more time. Firstly, what are substitutes? Substitutes are goods that are often used instead of each other. What are complements? Compliments are nice things you say to other people. Kidding. They're also things that are often brought together. Which of these pairs are substitutes? Coke and Pepsi, movie tickets and popcorn, or burgers and fries? The answer is Coke and Pepsi. You usually just buy one or the other. Which of these pairs of items are complements? Macca's and BK, bread and butter, or Spotify and Apple Music? The answer is bread and butter. Often you'll buy these things together. Which of these pairs are substitutes? Printers and ink, concert tickets and merch, or canola oil and sunflower oil? The answer is canola oil and sunflower oil. They do basically the same thing, so you usually just buy one or the other at once. Which of these pairs are complements? Red apples and green apples, PS5 and the Lego Batman game, or the Harry Potter book and the Harry Potter audiobook? The answer is the PS5 and Lego Batman. Often you'll buy a few games when you buy a new PlayStation. Here are some calculation questions now. When the price of smartphones rises by 10%, the quantity demanded for phone cases decreases by 6%. Calculate the cross-elasticity of demand between smartphones and phone cases. The question has given us percentages, so we use the percentage change method formula. The percentage change in quantity of phone cases is -6, since it decreases by 6%. The percentage change in the price of smartphones is +10, since it increases by 10%. -6 over 10 equals -0.6. This is a negative, so smartphones and phone cases are complementary goods, which makes sense because often when you buy a new phone, you'll also buy a new charger. The next question says, when the price of public transportation decreases by 5%, the quantity demanded for gasoline decreases by 3%. Calculate the cross-elasticity of demand between public transportation and gasoline. The percentage change in the quantity of gas is -3, since it decreases by 3%. The percentage change in the price of public transport is -5, since it decreases by 5%. -3 over -5 equals 0.6. So, because the answer is positive, public transport and gas are substitutes. Which makes sense, because if you take the bus, you don't need to buy petrol. You often don't buy both at the same time. The next question says, suppose we have two goods, raincoats and umbrellas. We want to calculate the cross-elasticity of demand for raincoats with respect to the price of umbrellas. The price of umbrellas increases from $15 to $20 each. As a result, the quantity demanded of raincoats decreases from 120 to 100. Here we have numbers rather than percentages, so we need to use the midpoint method. The new quantity of raincoats is 120, minus the old quantity, 100, over the old quantity plus the new quantity, 120 plus 100, over 2. All of this over the new price of umbrellas minus the old price, so 20 minus 15, over 15 plus 20, over 2. Alright, let's calculate this. The top half simplifies to -0.18. The bottom half simplifies to 0.29. -0.18 over 0.29 equals -0.62. This is a negative number, so raincoats and umbrellas are complementary goods, which makes sense because often you'll use a raincoat and an umbrella, unless you're in Wellington, where an umbrella only lasts 2 seconds. Here's another question. Suppose we have two goods, sunglasses A and sunscreen B. We want to calculate the cross-elasticity of demand for sunglasses with respect to the price of sunscreen. The price of sunscreen increases from $10 to $14 each. As a result, the quantity demanded of sunglasses decreases from 80 to 70. Again, we use the midpoint method. The new quantity of sunglasses is 70, minus the old quantity of sunglasses, 80, over 80 plus 70 over 2. All of this over the new price of sunscreen minus the old price of sunscreen, so 14 minus 10, over the average price, so 10 plus 14 over 2. The top half simplifies to -0.13. The bottom half simplifies to 0.33. -0.13 over 0.33 equals -0.39. This is a negative number, so sunglasses and sunscreen are complementary goods. Which makes sense, because on a hot day, you might want to pick up some new sunnies and some sunscreen to slip, slop, slap. The next question says, show the effect of an increase in the price of Cocoa Pops on the demand for milk. This means draw some graphs. Firstly, Cocoa Pops and milk are complements. So, when the price of Cocoa Pops increases, the demand for milk decreases. Because if Cocoa Pops are spinny, you'll use less milk. So, we need a graph showing the price of Cocoa Pops increasing and a graph showing the demand for milk decreasing, where your demand curve shifts to the left. Don't forget to label your graphs. Last question now. Show the effect of an increase in the price of Pizza Hut on the demand for Hell Pizza. Firstly, Pizza Hut and Hell Pizza are substitutes. Who would ever buy one pizza from each one at once? So, when the price of Pizza Hut increases, the demand for Hell Pizza increases. If Pizza Hut got more expensive, you'd just buy from Hell. So, we need a graph showing an increase in the price of Pizza Hut and a graph showing an increase in the demand for Hell, with the demand curve shifting to the right.
So that was all you need to know about calculating cross-price elasticity of demand. We're now going to look at how to calculate income elasticity of demand.
You might think that if you have more money to spend, you want to buy more stuff, but that's not always the case. This is because of something called income elasticity of demand, and this is what we're going to cover in depth today. Income elasticity of demand, or YED for short, is the responsiveness of quantity demanded to a change in income. So if you get more money, how much more you spend on stuff depends on income elasticity of demand. Before we get into how to calculate YED, there are 4 types of items that you'll need to know about. The first type of good or service is necessities. Necessities are essentials that you have to buy, for example, rent or electricity or petrol. You can't just not pay for these things, right? The opposite is luxuries. Luxuries are non-essentials that you don't have to buy. For example, eating out or going to the movies or going on holiday. These are things that you don't really have to buy, but they make you feel good. Note that luxuries doesn't mean Gucci handbags or Rolex watches. It includes those things, but it also includes simple luxuries, like going to the movies. Inferior goods are low-quality goods and services that people buy less of as income increases. For example, 2-minute noodles or frozen pizza or taking the bus. Inferior goods are things that you buy because you can't afford something else. You buy Pam's peanut butter because you don't want to pay for the nicer stuff, right? Or you take the bus because it's cheaper than driving. Naturally, when you get more money, you want to buy less of the stuff and more of the fancy stuff. Normal goods, the last category, are the opposite. They're goods that you demand more of when income increases. For example, coffee from a cafe, or eating out, or branded clothing. When you get more money, you'll want to buy more of this stuff. To figure out how to classify good or service into these 4 categories, we can calculate its income elasticity of demand. If the answer that we get is positive, then it will be a normal good. Or if it is negative, then it will be an inferior good. If YED is between 0 and 1, then it would be a necessity. Or if it's greater than 1, then it would be a luxury. Note that because all inferior goods are negative, we can't classify them as necessities or luxuries with this calculation. Alright, so how exactly do we calculate YED? Well, there are 2 main methods. The first is the percentage change method, where YED equals the percentage change in quantity divided by or over the percentage change in income. So the amount more or less that you buy over the amount more or less that you have. Let's do an example. Let's say that the quantity demanded of organic vegetables increases by 15% when income increases by 10%. Calculate the elasticity of income and state what kind of good it is. Well, the percentage change in quantity is positive 15 because it's increasing by 15%. The percentage change in income is positive 10 because income increases by 10%. 15 over 10 is 1.5, so YED is 1.5. Let's interpret this using our rules. In this case, YED is positive, so it's a normal good. Also, YED is above 1, so it's a luxury. And that's it. There is another way of calculating YED, and you have to know both for the internal. Method 2 is the midpoint method. It does look a little bit more complicated, but don't worry, we'll break it down. YED equals the change in quantity, so the new quantity Q2 minus the old quantity Q1, over the average quantity, so the old quantity plus the new quantity divided by 2. The brackets mean that you solve that mini fraction first. Alright, then we take all of this and we put it over the same thing for income. So we take the change in income, the new income Y2 minus the old income Y1 over the average income, so Y1 plus Y2 over 2. And that's it, I promise. Let's do an example. Suppose the quantity demanded of instant ramen noodles increases from 900 to 1,000 units when income decreases from $30,000 to $25,000. Calculate the elasticity of income and state what kind of good it is. The new quantity minus the old quantity is 1,000 minus 900, over the average quantity, so 900 plus 1,000 over 2. Over the same thing for income. So the new income minus the old income, 25,000 minus 30,000, over the average income. So 30,000 plus 25,000 over 2. Whew, all right, let's simplify that. The top half simplifies to 0.11. The bottom half simplifies to negative 0.18. 0.11 over negative 0.18 equals negative 0.61. Great, let's interpret this using our rules. In this case, YED is negative, so instant ramen noodles are inferior goods.
which makes sense because instant noodles is something that people in general would probably buy less of if they were richer. Great, that's basically all you need to know. There are, though, a couple of tricks that can be useful to know. If income and quantity demanded are moving in the same direction, i.e., both are increasing or both are decreasing, then the outcome will be positive, which means that it's a normal good. So if income was increasing and you buy more of the thing, then it's a normal good. Or if income and quantity demanded are moving in opposite directions, i.e., one is increasing and the other is decreasing, then the outcome will be negative, i.e., it's an inferior good. So if income is increasing but you buy less of the thing, then it's inferior. All right, here's a full summary of all you need to know. Necessities are essentials that you have to buy. Luxuries are non-essentials that you don't have to buy. Inferior goods are low-quality goods and services that people buy less of as income increases. Normal goods are goods that you demand more of when income increases. If YED is positive, then it's a normal good. If YED is negative, it's an inferior good. If YED is between 0 and 1, it's a necessity, or if YED is more than 1, it's a luxury, noting that inferior goods can't be necessities or luxuries with this calculation. And then we have the two calculation methods, the percentage change method and the midpoint method. Your learnings are not complete without reinforcement, so let's do some practice questions. What does income elasticity of demand mean? Income elasticity of demand, or YED for short, is the responsiveness of quantity demanded to a change in income. What are necessities? Necessities are essentials that you have to buy, for example, rent or electricity or petrol. What are luxuries? Luxuries are non-essentials that you don't need to buy, for example, movie tickets or jewelry or takeaways. What are inferior goods? Inferior goods are low-quality goods and services that people buy less of as income increases. For example, 2-minute noodles or bus tickets or margarine. What are normal goods? Normal goods are goods that you demand more of when income increases. For example, eating out or vacations or organic fruit. Which of these items is a necessity? A Harry Styles concert ticket, an iPhone 18, or school uniform? The answer is school uniform. It's an essential that you have to buy. Which of these items is a luxury? A candle, mortgage payments, or socks? The answer is a candle. It's a non-essential that you don't have to buy. Remember, luxuries aren't just designer handbags, they're any item that you don't have to buy. Which of these items is an inferior good? Starbucks coffee, powdered milk, or a new phone case? The answer is powdered milk. It's something that people tend to buy less of if they have more money. They would buy fresh milk instead. Which of these items is a normal good? An aeroplane ticket, 2-ply toilet paper, or Pam's chopped tomatoes? The answer is an aeroplane ticket. It's something that people want to buy more of when they become richer. Thin toilet paper and canned veggies are things that you'd probably buy less of instead. How would you classify something with a YED of 0.2? It's a necessity, since it's between 0 and 1, and a normal good, since it's positive. How would you classify something with a YED of negative 0.5? It is inferior because it is negative. How would you classify something with a YED of negative 1.2? It is inferior because it is negative. How would you classify something with a YED of 1.7? It is a normal good since it's positive, and it is a luxury since YED is more than 1. Here are some calculation questions now. Suppose the quantity demanded of plane tickets to Bali increases by 10% when income increases by 5%. Calculate the elasticity of income and state whether it is an inferior or normal good. This question uses percentages, so we use a percentage change method, where YED equals the percentage change in quantity over the percentage change in income. In this case, the percentage change in quantity of plane tickets to Bali is positive 10, over the percentage change in income, which is positive 5. 10 over 5 equals 2, so the YED is 2, which is more than 1 and positive, so plane tickets to Bali are a luxury and a normal good. Suppose the quantity demanded of public transportation decreases by 10%, when income increases by 15%. Calculate the elasticity of income and state whether it is an inferior or normal good. In this case, the percentage change in quantity is negative 10%, over the percentage change in income, which is positive 15. Negative 10 over 15 equals negative 0.67. YED is negative, so public transportation is inferior. Suppose the quantity demanded of Chamberlain coffee decreases from 1,500 to 1,200 units when income increases from $50,000 to $45,000. Calculate the elasticity of income and state whether it is an inferior or normal good. In this case, we've been given numbers rather than percentages, so we'll need to use the midpoint method. The new quantity is 1,200 minus the old quantity, 1,500, over the average quantity. So 1,500 plus 1,200 over 2. All of this over the same thing for income. The new income minus the old income, so 45,000 minus 50,000 over the average income. So 50,000 plus 45,000 over 2. Simplifying this gives us negative 0.22 over negative 0.11, and that equals 2. So Chamberlain coffee is a normal good and a luxury. Last question. Suppose the quantity demanded of Pix peanut butter decreases from 800 to 700 units when income decreases from $60,000 to $55,000. Calculate the elasticity of income and state whether it is an inferior or a normal good. In this instance, the new quantity minus the old quantity is 700 minus 800, over the average quantity, which is 800 plus 700 over 2. All of this over the same thing for income. So the new income minus the old income, 55,000 minus 60,000, over the average income. So 60,000 plus 55,000 over 2. Simplifying this gives you negative 0.13 over negative 0.09. This equals a YED of 1.44. So Pix peanut butter is a luxury and a normal good. So that was all you need to know about calculating income elasticity of demand. We're now going to take a look at how elasticity affects the incidence of tax. Taxing certain items affects producers and consumers in different ways, depending on the elasticity of demand. Who bears the brunt of a tax is what we call the incidence of tax, and this is what we're going to cover in depth today. The purpose is to make the thing more expensive so that people buy less of it. For example, taxes on cigarettes or alcohol. How this tax works is that the government tells, for example, the cigarette company, that for every pack of cigarettes they sell, they have to pay $2 tax to the government, or however much the government specifies. The cigarette company will therefore probably raise the price of the cigarettes so that the consumers can cover that tax. To illustrate the tax, we start with a regular demand and supply graph, showing equilibrium price and quantity. To illustrate the tax, we draw in a curve to the left of the supply curve. Make sure that it's parallel to the supply curve. We label this tax, or sometimes it's labeled S plus tax. It's all the same. Now we go ahead and draw in the new equilibrium, where the demand curve crosses over the tax curve. We call this QT for tax, and PC for the price that consumers are charged with this tax. You can see that the price consumers are charged is higher than the original amount, because now they have to pay that tax too. Then we need to draw in the price that producers receive. We go out from the point where that QT line hits the supply curve. We label this PP for the price that producers receive. You'll see that this is less than the original price. So when there is a tax placed on something, then the business has to pay that tax and therefore receives less money. This box is the value of the tax. you can see that it's the distance between the price that the consumers pay and the price that the producers receive. It applies up to the quantity that is brought under the tax, QT. This is the money that the business sends to the government as tax. That total tax revenue is partly covered by the producers and partly covered by the consumers. The extra amount that the consumer pays goes towards the tax revenue, so the distance between PC and PE. The amount less that the producers receive goes also towards the tax revenue, so the distance between PP and PE. On this graph, you can see that those amounts are pretty even, so the consumers and the producers split the burden of the tax pretty equally. However, when the elasticity of the item is different, these burdens do not get shared so equally. We'll now look at the difference between taxing an elastic item and an inelastic item. If the good or service has elastic demand, then its demand curve is going to be relatively flat. Elastic demand means that a price change results in a relatively larger change in quantity. It's things that people are quite sensitive to price changes for, like maybe eating out at a restaurant. If that suddenly became quite expensive, then way less people would stop eating out. Or like butter. When the price of butter is quite high, people buy way less butter and maybe just buy some margarine instead. When we add in the tax curve and label the resulting PC and PP, we can see that the extra amount that the consumer pays is pretty small, but the amount less that the producer receives is quite a lot less. This results in the tax paid by the consumer being pretty small, and the amount paid by the producer being pretty big. So, for a tax placed on elastic goods, the incidence, or the burden, falls more on the producers. Basically, if consumers are pretty sensitive to price changes, then the producers don't want to make them pay too much more because they'll lose all their customers. So it's better for the producer to just cover most of their costs themselves. The producers will absorb more of the tax themselves to keep the price rise lower and prevent the quantity demanded from dropping too much. For a tax on inelastic goods, the opposite is true. For a tax placed on inelastic goods, the incidence falls more on consumers. The producers will pass more of the tax onto the consumers as they are less concerned about the quantity demanded dropping. Inelastic demand means that the change in price is proportionately larger than the change in quantity. It means that even when the price increases, people will still buy heaps of it anyway. For example, petrol, or rent, or electricity. Even when these things get expensive, people still buy a lot of it, right? They might buy a little bit less, but not heaps less. Something with inelastic demand has a steeper demand curve. Let's have a look at what happens when we draw in the tax. You can see that having a steeper demand curve results in the price consumers pay under the tax, PC, increasing by quite a bit, whereas the price that producers receive under the tax, PP, is only a wee bit less. This results in the tax paid by the consumer being pretty big and the amount paid by the producer being pretty small. So for a tax placed on inelastic goods, the incidence, or the burden, falls more on the consumers. Basically, if consumers aren't that sensitive to price changes, then the producers will take advantage of this and make them pay most of the tax because they'll just pay this high price anyway. So with inelastic demand, the producers will pass more of the tax on to consumers as they are less concerned about the quantity demanded dropping. There's really only one more thing to note. The government prefers taxing inelastic goods because they receive more tax revenue. If we were to compare the two situations, we can see that taxing inelastic items results in only a small decrease in quantity, whereas taxing elastic items results in a fairly big decrease in quantity. So the amount brought under the tax on inelastic items is more than the amount brought for elastic items. If there are more things being brought, then there's more tax getting paid. So the government makes more money off of the inelastic items. Think about, for example, cigarettes. Cigarettes are something that people buy even if there is a big tax placed on them. The government can actually take advantage of this and get heaps of tax money off of cigarettes. However, is that really fair? Well, that's another question. Taxing something like cigarettes with an elastic demand isn't really that effective in achieving the goals of reducing the amount that people buy, because people still buy them anyway because they're addicted. And now we're just making life even harder for these people who are addicted, who are likely already low income or struggling with other aspects of life. Anyway, that's something you might want to think about. Here's a full summary of the key things you need to know. For a tax placed on inelastic goods, the incidence falls more on producers. The producers will absorb more of the tax themselves to keep the price rise lower and prevent the quantity demanded from dropping too much. For a tax placed on inelastic goods, the incidence falls more on consumers. The producers will pass on more of the tax to the consumers as they are less concerned about the quantity demanded dropping. And the government prefers taxing inelastic goods because they receive more tax revenue. Let's reinforce these new learnings with some practice questions. When there is a tax on an elastic good, who bears the incidence of tax? The answer is the producers. The producers will absorb more of the tax themselves to keep the price rise lower and prevent the quantity demanded from dropping too much. When there is a tax on an inelastic good, who bears the incidence of the tax? The answer is the consumers. The producers will pass more of the tax onto the consumers as they are less concerned about the quantity demanded dropping. Why do producers bear the incidence of tax for goods with elastic demand? The producers will absorb more of the tax themselves to keep the price rise lower and prevent the quantity demanded from dropping too much. Why do consumers bear the incidence of tax for goods with inelastic demand? The producers will pass more of the tax on to consumers as they are less concerned about the quantity demanded dropping. Draw a graph showing a tax placed on a good with elastic demand and label the incidence of tax. Here's the answer. The demand curve is elastic, so relatively flat. The tax curve is to the left of the supply curve, resulting in QT, PC, and PP. The tax paid by the consumers is smaller than the tax paid by the producers. Draw a graph showing a tax placed on a good with inelastic demand and label the incidence of tax. The demand curve is inelastic, so relatively steep. The tax curve is to the left of the supply curve, resulting in QT, PC, and PP. The tax paid by the consumers is larger than the tax paid by the producers. Does the government receive more tax revenue from goods with inelastic or elastic demand? The government prefers taxing inelastic goods because they receive more tax revenue. You can see that when we compare the two graphs, the tax revenue is larger for the inelastic good than it is for the elastic good.
Alright, that was the final topic, so we've now covered everything you need to know to ace this internal. Shortly we'll release a few videos where we go through full practice tests for elasticity, so head to our channel to find those videos. The resources on the internet are saturated with American-based content, and there are very little resources addressing NCEA economics. If you found this video useful, please consider liking and subscribing. I know it sounds typical, but it really does make a difference for the algorithm, so that we can keep making educational New Zealand-based economics videos, and help it to reach those who need it. Alright, that's all for now. Good luck for your test everyone, let us know how you did in the comments. See you next time for more big brain energy.